Hey traders, this is Blake Morrow with Trader Summit, and I've got Mr. Jim Welsh with us from Macro Tides. Jim, good to see you. From what I understand, you're not feeling 100% right now.
Not 100%, but I'm here, Blake.
You are.
Warriors never back down.
That's right. I love it. I love the attitude. And I know we probably need to get through all this information you brought for us as quickly as possible, but there is a lot to go through because it's been a big week, right?
It really has. A lot of ground has been covered. Obviously there are several big things that happened. The Treasury came out and said, yes, we're going to be issuing $700 and some billion worth of paper in the fourth quarter, a little over 800 in the first quarter. That was less than what people had expected. Plus, and maybe this is the more important aspect, is that they weighted more of the issuance shorter dated maturities. So they reduced the amount 10, 20, and 30-year paper, not by a lot, but by some. And that acted as kind of a trigger to ignite, obviously, a rally in the bond market. And then, Powell, to me, didn't say anything that anyone should have been surprised. Given the data that the Fed has been watching, they have to keep in place the possibility of raising the funds rate. And then obviously we saw the employment report come out today. The ISM manufacturing and ISM services numbers came out, both showing softening. The employment report showing softening. So yeah, in sum, what you got is a week where I think most traders, or at least on Wall Street, have concluded that the Fed is done raising rates. I don't disagree with that. I think the big difference, Blake, is they believe that because the Fed's done, therefore nothing what they've done previously is really going to matter that much. That the economy isn't going to slow. The risk of recession is pretty much non-existent after the GDP report we got last week. And that's where I part company. I think that the table is set for the economy to slow materially over the next 3 to 6 months.
Yeah, because and you're right. Today's data, and throughout the course of the week, really, if you look at most of the data, it's weakening, it's softening, but it's not capitulating. But that's how every trend starts, right? It starts with a little, and you're like, okay, hey, we didn't create as many jobs this month. The ISM has dropped, to 50 point whatever, and it's not contractionary. So as far as the traders can see, which happens to be about right here, it looks Goldilockish.
Yes.
But what's beyond that could be even worse. But let me ask you this, and I know you got a bunch of charts to show us, and so this is where you go, okay, well, the markets are disconnecting with maybe what reality might be, but you got seasonalities playing into effect. You got probably really poor long side positioning. Can't this rally, or did you just give me a cold? Can this rally continue even further than what we've seen already?
Yes. For all the reasons you cited. And again, last week when we talked and we reviewed all the charts, it was like things are set up for a rally. And we, had some targets, which we'll go through. And so the positioning, kind of just adds a lot of octane to it because people were bracing for the worst, if you will, and thinking about the 10-year going to 5.5%, maybe even 6% because of all this issue. But at the same time, the charts and various technical indicators were saying, wait a second, we're about to see rates come down. We're about to see the S&P rally. And here are some targets. Yeah. And all of a sudden the data and the news comes in, and lo and behold, it's supportive of a rally. And we're already getting to some of the targets that we talked about last Friday morning. So yes, it can continue. And as you pointed out, the data is slowing, nothing to be concerned about, folks. But I believe, as you know, that as we get further along in the next few months, the data is going to continue to slow, and at some point in time cause people to, if you will, second guess the idea that we don't have to worry about the economy slowing materially or a recession.
All right.
And that's going to be the difference in both where potentially yields can come down, but the equity market doesn't respond favorably to that. Right now, as you noted, it's just gradual signs of slowing, which means, okay, we can still hang on to our idea that earnings are going to be up 10 to 12% next year.
Right.
I mean, yields are coming down. This is Goldilocks. This is perfect. So the slowing has to be serious enough to get people to say, wait a second here. Maybe that 10 to 12% of earnings growth in 2024 should be questioned.
And it could be, the slowdown in the economy can end up being slow, but it just continues to grind slower. And, and then you go, wow, okay, now we're really like this economy is slow. It's gotten to a point where it's at a screeching halt, but it happens as like a slow moving train wreck, if you will. But
yeah, well, it's like the book Sun Also Rises. The guy said, well, how did you go bankrupt? Gradually and then suddenly. And that's typical. I mean, last week, one of the charts we showed, Blake, was in the third quarter of 2007, GDP was up 4.9%. The fourth quarter, I think, was marginally up like 0.6. And by July of 2008, the National Bureau of Economic Research, which is the arbiter of recessions and recoveries, revised the numbers down to a minus 0.2. So that's why they say, oh, hey, the recession began before the end of 2007. So this growth that we saw in the GDP report for the third quarter, to me, to a large extent, is a head fake. Now, the ultimate question is going to be, how much slowing do we see over the next 3 to 6 months? And as we're going to look at some charts, we're going to look at why expecting more slowing, I think, is the right course.
Well, let's get into it. And let's talk about your first chart that you brought up here. Can you tell us a little bit about the spending more than income chart?
So, one of the things that has really helped the economy defy a lot of people's, projections of a recession, both last year, it's going to happen this year, was excess savings. People got a lot of money from the government. For a while, they couldn't go out and spend it. But what we've seen since the end of 2021 is the blue line on the chart on the left is spending. So they're spending more than their income. Well, how can they do that? Excuse me. Well, because they have this pool of excess savings that they're drawing down. The chart on the right shows the absolute savings rate. So what we can see is in 2018 and 19, the savings rate was north of 5%. And spiked up because people got all this money, they couldn't go out. But now you can see, Blake, how it continues to decline since it had a little rebound into May, and it's been declining ever since. So to me, what that implies is the acceleration of depletion of the excess savings pool, means that it is shrinking more rapidly, and that savings pool is not inexhaustible. So that the longer this goes on and more people exhaust the savings rate, at some point in time, we're going to see spending begin to pull back. And there were a number of CEOs in the last week that talked about there's been a change in consumers' behavior in terms of how they're spending, what they're spending money on, the volumes of things, of things that are being sold. Yeah, the price might be up a little bit because of inflation, but the volume is down. These are all, precursors to a more significant pullback by consumer spending. So, you look at the 4.9% GDP. Well, 2.8% of that was a 4% increase in consumer spending in the third quarter. Hence the drawdown in savings. So to me, that strength is almost a little bit like a last hurrah, potentially. And so this is setting the table for a retrenchment by consumers. And so we're going to see things really slow, I think, materially. These charts support that conclusion.
And the next chart you brought up is the ISM Services, and this is the data we got today.
Yeah.
Correct?
Yeah.
This is
Yeah.
it. Okay.
Yep, that's it. So I think it was Monday or probably Wednesday, we got the ISM manufacturing. It was below 50. All right. Well, this is services. And the distinction here is manufacturing is like 12% of GDP. Services about 80%. So the fact that it's above 50, it still means it's expanding. But what we can see is a clear slowing in services activity. And so to me, it's just a question of when this thing slows enough and we'll see it dip below 50. My guess would be sometime in the next 3 to 6 months. The other thing I would point out is if you look to the left-hand side of the chart and you can see, is that 2021? Now I got to put my glasses.
2020, this
20,
is 2020.
yeah. So before
COVID.
COVID hit. So now we're below where it was throughout all of 2019.
Yeah.
So, again, these are all, suggestive that the slowing in this trend is going to continue. And it projects at some point in time in the next 3 to 6 months, it very likely will drop below 50 and be a contraction. So manufacturing is 15% of GDP. There was a huge surge of buying initially because of COVID and the money people had on goods. That has kind of pulled back. And I think slowly but surely we're seeing people pull back on what they're spending in terms of, the travel plans, restaurants, going to concerts, all those types of things. So again, 4.9% in GDP has got everybody, like, oh my God, this is just a wonderful thing. And I don't think they're paying enough attention to the stuff we're talking about.
But Jim, everybody's got their jobs. Look at that. You see what I did there? You see that?
Yeah, you did. You did. Because that's what everybody keeps saying. Hey, the job market's still good. Well, just look at this. You have these, periodic spikes up. But if you just look at this, like, well, okay, this thing is definitely trending lower over time. And it's like the services. Slowly but surely, we're seeing fewer and fewer jobs. Now, the household survey over the last 3 months actually shows a net loss of jobs. In late 2007, that's what happened. We were continuing to see job growth as measured by the establishment survey, and the household survey was showing negative job growth. And these two things kind of come together. And if when they're blended right now, instead of a 200,000+ average for the last 3 months, it's closer to 100,000. The unemployment rate ticked up. Historically, whenever it goes up by 0.5 percentage point, you have a recession. Well, it's gone up by 0.5 percentage point. So these are all the things that, to me, people need to be focused on, not the 4.9% GDP number, the trends that we're seeing under the surface. And it implies that we're headed for slower growth. And once, that growth slows down enough, all of a sudden we'll start to see layoffs.
Well, Jim, I don't want to miss this rally to all-time highs. So tell me where I'm wrong. Okay, the dollar is it got absolutely destroyed this week, and I'm going to do a little bit of drawing for you, just really quick. This level here, we are basically below it, but I can also argue that we got a bull flag pattern too. So it's interesting. Just when everybody thinks it's time to be bearish, we could always turn. I'm not saying that's going to happen right now, but it does. Right. I mean, price action is pretty bearish in the dollar this week, right?
Well, absolutely. But again, we've been talking about this for probably 2 or 3 weeks, that a drop below the 105.36 low was coming. If you look at it from the high at 107.34, I think, that decline down to the little letter A, that ABC, that's corrected. That doesn't look impulsive. The rally back up to the high this week, ABC, and now we're seeing this sharp break, which is exactly what's supposed to happen in a C wave. I think we're in wave 3 of C. So I think there's a little bit more weakness to come in the dollar index. But this pattern, Blake, implies that that this is a correction from the uptrend that we saw from the July low. And so my view has been is we're going to see a drop below under 105.36, maybe getting down to 104.40. But what's going to happen after that is another rally above 107.34. In other words, take out the highs and potentially up to 109 to 110. So to me, this pullback is corrective. And, you know, I remember back in July when the dollar dropped below 101, I think it was 100.70 because there had been prior lows there. Everybody got really bearish. But we had talked back then as like, hey, you got an ABCD triangle. There should be a plunge that takes that out, get everybody negative, and that will set a rally up. And the initial target was 104. And then, you know, we increased the target as things unfolded. So, you know, again, to me, the chart just looks still constructive, irrespective of this break. Now, you get below 104, you know, then I would have to say I'm probably wrong.
Yeah, but, and your buddy and mine, Dale Pinkerty, and if we remember, there's an old channel that goes something like that, comes in somewhere around there, you know. So that to me makes sense. I mean, that's where, you know, that we would potentially see that.
Yes, yeah, and again, the assumption everyone's making is that you know, the Fed's done and so forth. Again, I just think that again, I think there's another rally coming. I think the big decline in the dollar happens next year when the economy truly is slowing meaningfully. And it's like, wow, not only is the Fed done, but people will start looking forward and saying, now it's just a question of when they're going to cut rates. And I think that's really what causes the dollar to pull back. And my guess would be, you know, let's say it got up to 109, 110. I think a pullback to 101 is coming. You know, after that. So that's the longer term picture going out into next year. You know, we'll see how it unfolds in the next 2-3 weeks.
All right. Well, the next chart you have is gold, and gold has been pretty strong. I mean, it hasn't given it up. It's stayed well above 1950, but it's yet to break 2000. So what do you think here?
Well, you know, honestly, I'm a little disappointed that gold hasn't done a little bit more given the weakness we've seen in the dollar. But you're 100% right. It had this huge rally over like 10 days or so, and it's not given up the ground. So I continue to think, if you looking at from the lows, to me it's 1, 2, 3, 4, 5, 6, 7. Well, advancing waves are either 5, 9, or 13. All right. So what that implies is this recent pullback in gold this week is like wave 8. We need one more push above that 2008 high to complete 9 waves up. I still think there's a shot that it can get up towards the 2031. It could even take that out. So the other thing, obviously, the red and green moving averages. The red is 5, the green is 13. They're exponential averages, so they're constructive. I thought if we pulled back to about 1975, that, you know, everything is going to be copacetic in terms of having one more move. The pullback was 1972 and change, and then we popped. So I think the odds still favor that we're going to see another pop in gold before this initial move up from the low we saw at 1812 is complete.
All right. Okay. Well, you know, let's see how it pans out there. Now, you've been pretty spot on with this move in the bond market. Correct me if I'm wrong, but you were buying TLT last week.
Yeah.
Or the week before, actually.
Yeah, the week before. Okay. So, you know, this was I sent out an update on October 23rd.
To the Macro Tides subscribers, just so everybody knows.
Yep. You know, time to buy TLT. So what I cited in that special report, Blake, was that you had a lot of technical reasons why it was time to buy. And we've talked about this in the past, something called intermarket divergences. And what happens, you'll see it happen in gold and silver too, but it happens between the 10 and the 30-year Treasury bond futures, where one will make a new high or new low, and the other one doesn't. So in April, the 10-year went to a lower low, the 30-year didn't, in negative intermarket divergence. What we saw a couple of weeks ago was the 30-year went to a lower low. I think it was on October 23rd. The 10-year didn't, and then there was a pretty significant reversal. In fact, it was a 2-day key reversal. So the low was lower than the prior 2 days, the high was higher, and obviously it was a positive close. RSI, there was positive divergences where, yeah, you made a new low, and that red line on the bottom panel kind of shows it. Hey, you made a new high in yields, but the RSI was showing a positive divergence. So all of that, to me said technically we're there, and it's time to buy. You never know what the fundamental reasons are going to be. So it turned out it was a combination of things. I think that the 10-year can get down towards that red horizontal line at 436. Now it's not going to be a straight line. We're going to, bounce and all the rest of that along the way. Ultimately, if I'm right about a recession, or a meaningful slowdown happening, the 10-year can go down, yield wise can go down a lot more. In other words, below 350.
Wait, so I'm going to be able to refinance my my 8% mortgage back at 6.5%? Is that what you're saying?
Happy days are here again.
Happy days are here again. Well, let's hope
I
so.
think 90% of people have a mortgage that's 5% or less.
Yeah, some silly number. I mean, it's
something like that. Okay, so that was the setup on TLT when we talked on October 20th. It was kind of like, hey, folks, you got 5 down from the high in March of 2020, that 179.70. There was a chance it could drop under 80. That was a realistic thing, which is why, I suggested, okay, you get below 82.74, it's time to start scaling in. Now, as it turned out, the low was 82.42. I mean, it very well could have gone under 80. All right. But that's why when you get to a point where, gosh, the big picture is starting to become more and more constructive. And the potential here is that TLT, again, I think there's going to be a big slowdown, maybe recession in the first half of next year. All of a sudden, TLT can rally to 105 and maybe as high as 119. I think the 105 to 109 range, is far more likely, obviously, than 119. But it just showed that the risk reward was, okay, maybe 3 or 4 points to the downside at worst, and potentially 25 points to the upside. And that to me is where this is where stepping back and seeing some big long-term charts can really help, because over the last 2-3 weeks, as you know, a lot of people were like 5.5%, 6%. Oh my God, all this supply from the Treasury. Oh, it's just going to swamp. And it is going to swamp. I mean, my longer term outlook is after we get this big rally, wherever it winds up going to, I think Treasury yields are going to go to a higher high. Because what's going to happen if we do get a recession? The deficit, which was 1.7 trillion, the largest deficit ever, while the economy was growing and outside of a recession, could easily be 3.5 trillion, maybe 4 trillion, depending on just how deep it is, how long it lasts. That's an enormous amount of supply.
It is.
So to me, that 5 down implies that that's the first leg down of a bigger bear market. We're going to get this big rally, and then I think yields are going to make another 5-wave, or TLT will make another 5-wave decline from whatever the high is over the next 6 to 9 months.
And that's really, if you think about what Jim's been saying, guys and gals, that's what gets the dollar index to 109 again, something like that.
Yeah. Well, again, there's stuff going obviously in the Middle East over the next few months. I mean, the dollar's going to get to 109 or so, Blake. I think it's going to happen going into year end.
Wow. Really?
Would be my guess. Yeah. I think that's
I wasn't thinking that
like,
far. I was thinking way further out than that. But
yeah, no, I think if it's going to happen, because I think as we get further into next year, I think the economy is going to slow a lot. And people are going to be looking at monetary policy and saying, wait a second, the Fed's not only just pausing here, they're going to actually have to cut rates. And I think that's when the dollar becomes far more vulnerable to a larger correction. So, yeah, I think there's a spike up above the 107.34 coming. And then I think as we get into next year, the dollar is going to be to a much larger decline.
All right. Well, the second to last chart you brought is the S&P equal weighted chart. So
Yep.
what's this telling us? It still looks constructive.
Yeah. Well, we talked last week, and I said, hey, we're actually over the last 2 weeks. I showed this chart 2 weeks ago. It's like you got to look at sometimes not just the S&P to get an idea.
Right.
And looking at this chart, and I think we looked at the Russell, the value line. It's like I believe the S&P is going below 42.16. Why? Because all these other averages have already done that. The target was under 134, where 1 and 5 would be equal. You can see 5 waves down, that are marked in green. Well, once you complete that, that means you're going to get a rally. So last week it was like, all right, I think we're going to rally. And the target is 103 or 143.50, which is nothing more than the high from 2-3 weeks ago. And the 50% retracement is 145. The blue line is around 146. And, here we are. It got up to, I think, of almost 142.
Yeah.
So this is, to me, like, all right, this is what was likely to happen based on this 5 waves down. Just like we saw on TLT, should rally. This should also rally. And I think it will likely be an A, B, C. And so it could consume some time and last, into early December, maybe end of the year. People really, really believe that there isn't going to be a recession, Blake.
Right.
And to your point is things are slowing. Well, that's perfect. Slowing and rates coming down and the Fed stopping, we can't ask for anything more than that. And so that can persist for another, 3 to 6 weeks.
All right. Well, Jim, here's your S&P chart. And so tell us, how far can this market squeeze? Because we are squeezing. And I like to remind people that haven't been through bear markets. Bear market rallies are nasty. They're vicious. Yeah. And they're pretty convincing too. That usually puts everybody else in the we are going to all-time high camp, right? So
yeah. And honestly, there's still a small chance that could happen. In other words, we keep getting data that's just slowing a little bit, and people buy into this idea, no recession and everything else. Again, what was pointed out last week is you had a divergence on this 21-day advanced decline oscillator. Historically, that's usually set you up. S&P made a lower low, but the breadth wasn't quite as negative. And, to me, it was like, okay, a rally to 43.65 and the 618 is 44.20. And I don't know exactly what the high is today, but I think we're getting close to 43.
43, about 70 right now, 60s,
okay.
70s. Yeah.
Yeah. And you're 100% right. The reason why bear market rallies are so dynamic is you get a piece of news that inspires some people who have been negative. Hey, maybe I should do some buying. But the negative news that it built up has a lot of people that are positioned to expect even lower prices. So all of a sudden you get a move like this, and the more intense it is, the more short covering you get in a compressed period of time. And so you get these huge spikes that look fabulous. They're like, holy Moses, this is a new bull market right here, baby.
Right.
And that's what bear market rallies look like. Whereas in a bull market, you make a 4% move and it's usually over 3 weeks, maybe even longer. Just the steady climb, boring, but just steady climb.
Right.
So the way we're rallying is also indicative of, I think, a bear market rally. Now, again, this has the potential of going further. Just last week, it was like things are set up for this rally. And then as it unfolds, you can make some guesses in terms of, well, just how high is this going to go? Same thing. I anticipate an A up, a pullback, and then a wave C. it can get up to 45, 41 on a pullback, given the length of this, what is, I think, wave A of this rebound. So, it comes down to when we get evidence that, okay, wave A is over and we get a little pullback. And we say, well, wave A was 240 points or whatever it turns out to be. And we look at the depth of the pullback. And then we can say, okay, well, what would the quality be? Adding 240 points to that. So that's where, these are all guesses.
Sure.
But it helps for me to have a framework. And obviously, when the market approaches various targets, then you hone down and look at, what are the technicals showing? Are we seeing more or less momentum? Are there divergences? So on and so forth. But, a lot of things were set up for a rally. It's just, if you had told me, Jim, how soon do you think the S&P is going to get to 4360 last Friday? I would not have said next Friday.
Yeah, right.
I wouldn't have. I mean, I know I wouldn't have. It'd been more like, oh, maybe over the next 2-3 weeks. I mean, it's like all the tumblers. Somebody's cracking the safe, man. All the tumblers fell into alignment here to get everybody like, oh my God, I'm in Iowa. This must be heaven.
Yeah. And that happens. I mean, that happens in the market, and a lot of it just came into play this week. So next week will be interesting, I think. And you'll be here to hopefully feeling a little bit better to guide us through it. And matter of fact, guys, gals, if you haven't given Jim's a thumbs up yet, make sure you do so. Subscribe to this channel so you don't miss any of the content exclusively here on Trader Summit. And also get to macrotides.com and send Jim an email. What's the email, Jim?
Jim Welsh Macro at Gmail. And the new website that I had, talked about a couple of weeks ago is up and running. So go to macrotides.com. You'll read some good information. I have an overview there, Blake, that says, okay, this is what I said from 2021 forward, about the dollar, stocks, gold, and bonds. And it'll give you, I think, an idea, because I'm assuming that there's people who catch one of these videos and they may not catch another one for 3 weeks or longer. And so there's kind of an aspect of being disjointed. Look at the overview piece, and I think you'll come away being impressed.
All right. Well, I'm sure everybody wants to go visit the site. So thank you. Make sure you guys and gals all do that. Jim, feel better. I look forward to catching up with you next week. And have a great week.
You too. Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.